Welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest Steve Lentz from Discover Options and OptionVue. Before we get started, a quick disclaimer: the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And I'm sure, Steve, you guys have similar disclaimers at OptionVue, so take this with a grain of salt if you're a new trader and just learn from it. If you're an experienced trader, use your own discretion to put some trades on. So with that, Steve, welcome back. I guess this is a kind of a part two to that other presentation you did a couple months ago, I guess it is now.
That's correct. That's what it's on the Volatility Edge Analysis, and I think I hope everyone likes it. I think everyone will get something from this.
Oh, and it looks like Jim Riggio has joined us too. Steve, I don't know, have you met Jim?
We did the last time.
Oh yeah, Jim and I. Yeah, we have. We've met a few years back. So I guess I was on a trip someplace. I think I remember meeting you, Jim.
Yeah, we met once, and we talked last time when you were on. Thanks again for coming on, Steve.
Sure, absolutely. Should I just go, or what do you want me to do, Tom? Are you ready?
Yeah, you've got the ball, so you should be able to share your screen at this point.
All right, so let me see here. Share. I click my screen, sharing my screen.
And something's loading. That's good.
Something good's happening. Okay, so I'm going to click that. I'm going to go to F5, and hopefully that should fill up your screen just fine. Is that working?
Perfect.
Okay, and can you see the little arrow when I move it?
Yep, we can see your cursor.
Perfect. Okay. All right, so folks, I'm Steve Lentz with Discover Options. We are the educational arm of OptionVue Systems, and we focus exclusively on the one-on-one mentoring experience. And we have a team of mentors, and it's kind of like tag team mentoring. And so we have multiple levels of mentoring, levels 1, 2, and 3. Level 3 is primarily for just the non-directional, what people call income-type trading, butterflies, condors, and everything. And so the material I'm going to present here is kind of an offshoot of the things that we do in the context of the non-directional type trading. We have a whole series on directional, whole series on option overlays, and then a whole nother level on just futures trading, futures options trading. So for the folks in our mentoring program that are in level 3, they're able to access a weekly presentation I do called the Inside Wire, and I do some research, and whatever I'm researching at that time I kind of present to the folks that care to join in, and then we archive these as well. And so something I worked on last year was called Statistical Edge Analysis, where I just sought to find out truly if certain technical setups in price action actually did better than just random flipping of a coin. And perhaps in your own trading, you kind of have maybe 2, 3, 4 losers in a row, and you begin to wonder, good grief, perhaps I could just flip a coin and do better than this, right? And so that's what I sought to do. And I got into my Metastock program, and I went crazy. It took me months to build this engine to get some statistical work done to evaluate any technical setup to determine if it's better than just flipping a coin. And so I took some of that engine and applying it now to what I call Volatility Edge Analysis, and that is where I really want to examine implied and statistical volatility or historical volatility, and kind of attack it from a different perspective. I never have been comfortable with the way that it's been presented in the past. And so now these initial slides are going to be from the April presentation I did, and I'm going to instead take this to a direction where I'm going to show you how there's some seasonal and technical setups in the Russell that if you're if you trade butterflies, neutral butterflies, condors, and you're that kind of a non-directional income, premium collection type trader, that there are certain seasonal and technical aspects in the Russell where you can squeeze out a significant edge in the timing of your butterflies and condors relative to the day of the week and price action. Okay, and so in fact, a 7.5% edge over and above the 15 normally available in the Russell. So we're going to increase your edge dramatically with this little bit of information you'll learn here. So here's a volatility chart, typical what you would see at iVol. This is an OptionVue one where you have implied volatility in the blue. And OptionVue now has a 30-day running implied volatility similar to the VIX. In the Russell, it would be similar to the RVX. And then OptionVue uses a statistical volatility line there. It's looking at the last 20 days of each day's high and low. And it's exponentially weighted to the front side. But that's OptionVue's way of determining statistical or historical volatility. Now, what's interesting here is that implied volatility, remember, is measuring an expectation of the future, whereas statistical or historical vol, some call it, actual vol, realized vol, is a measurement of the past. And so really you're looking at apples and oranges here. So if you were to take any one data point, you're really looking at apples and oranges. And we really want to have a way of locking this up so we can ascertain the true character of the market from a volatility perspective. So here are the 4 steps in volatility edge analysis. First, we need to understand an implied 30-day move, or 21 trading days, 30-day calendar days. We need to understand what the implied volatility is saying about the future in terms of how much it's actually predicted to move. Then we have to look at what actually transpires. Okay, an actual 30-day move. Then we're going to take a look at that particular market. Today we'll look at the Russell using the RVX, which was published starting in 2006. And we're going to look at the random distribution of how much the RVX is implying about the future versus what actually transpires. Okay, we're gonna look at it from an apples to apples perspective, and then we're going to see if there's any baseline edge to that given market, the Russell in this case. Once we have that baseline edge and understand the random distribution of how much the market moves relative to what was implied, well, then we're going to take a look at some setups. Last time we looked at a 40-day moving average, and we came up with the evidence that if you just put on your butters and condors when the price is above the 40-day moving average, you would have an extra edge of about 5%. And what we're going to show you today is a way to extract an additional 7.5% using the MACD and the day of the week study. All right? So that's what we're going to do, is walk you through all of these parts here. Let's first look at the implied 30-day move, and then I occasionally like to get a sip of coffee and clear my throat here. One moment. All right. All right, implied 30-day move. Here's the Russell. We're looking back in March. You got the RVX down there, tooling around down, under 20 somewhere back in March. Well, you can take that RVX and run it through some algorithms to then get an implied move. In this case, if the RVX is at 17.96, and I show you down there the standard deviation algorithm there, we can take from that RVX of 17.96 that it is implying a move over the next 21 bars of 63.6 points. All right, that's what that RVX 17 is implying about the future move 21 days out. That's the implied move. Now 63.6 is what percent of the actual Russell? Well, it's an implied move of about 5.2%, and that's what I like to use, is just an implied move in terms of a percentage of the index. All right, so at that time, RVX was implying a move of 5.2%. Okay, so now, and I want to make you keep in mind that 63.6, because I'm going to verify this by going to a probability calculator in OptionVue, and I'll show you a few other probability calculators. But if you were to take, basically, if you were to take the first standard deviation here, in this case 12.97, that's about 65 points on the upside. We're plugging in the standard deviation to the downside, and that puts us at 61.8, and that's because of the log normal distribution here kind of built in. Roughly an average there works out to about 63.56, very close to the 63.6 that we just measured. So that's what we're going to do. We're just verifying it using the probability calculator that indeed we're broadcasting out a standard deviation there. All right? Now, let's look at the actual 30-day move. And in Metastock, I came up with this thing. You can easily program your own indicators. The question here is how far did the market move from any given close? What was the maximum percentage, whether it went up or down? We don't care if it went up or down. We're just interested in how far it actually moved. So let's just take an example over here. You have the close of that peak day back there. It looks like December 29th. And if you look at the next 21 days, the lowest that it didn't go high very much, but it went it went down quite a bit. It actually, over the next 21 days, the lowest low of the next 21 days was 1151.3. What percentage of a move was that? Well, when you crunch the numbers, it works out to about a 5.56% move on the downside. So when we go back to that December 29th and we look at the indicator there it is, 5.56 was noted. So now we're looking into the future. See where we're going with this? We're getting ready to go with apples and apples. We're looking in the future there. How far did the market move? Well, it moved from that close up there at 1219. It moved 5.56 in the future. Okay? Yeah, let's take one more example. Here's one where the market clearly went up more, went up and peaked out right there. That was the highest move. Okay, when you crunch it, let me see. Yeah, when you crunch the numbers, it works out to about an upward move of 3.48. Okay, real simple. So that's what that red line is down there. Now, here's the question. At that time, what was the RVX saying about the move in the future? And there it is. I'm going to put the RVX on top, and we could see, well, it's not the RVX. I'm extracting the implied move of the RVX. The RVX implied a move of 6%, yet it only moved 3.4%. So we could have sold premium 6% out of the money. We knew that it was implying a move of 6%. We could sell a standard deviation away, and indeed the market would have gone up there, but it didn't really come close to testing the move at 6% out of the money way up there. So if you'd have done a one standard deviation condor, this would have been fine, meaning that the short strikes were set a standard deviation out of the money. So we know that as of that date, that kind of a trade would have worked out okay. All right? Now, yeah, let's see. Oh, here I'm just documenting this, etc. Yeah, it would have had to go to 1274 for this to get in trouble, and that was way up there. So this thing stayed really, really close relative to what the RVX was implying. Now, here's the grand question. We need to look at the character of the Russell. How often, going back, was the implied move higher than the actual move? We can see here on this screen, indeed, the RVX implied a move greater than what actually occurred pretty much all the time here, at least for these 3 months showing. All right, so we want to get to the character of this market, and that's what that question is. And so what we're going to do now is look at that random distribution of those two types of volatility. How much was implied? What actually happened? And then we're going to go to a baseline edge. So we're moving right along here, okay? Yeah, Tom, we're moving real quick here. I've done this a few times for my folks, and believe me, it's we'll have a lot of time for questions and comments, which is fine here. All right.
Fine.
So here's what I did. I went back to May 5th of 06, walked all the way up to the present pretty well. And if you take every single close and run that analysis, what was the RVX implying, what actually happened? Okay, look up at the top there. Well, you can see here, down here you can see my cursor. When the red line is above the blue, that means that the actual move was higher than what the RVX implied as of that close. Okay, and then when the blue is above the red, that's clear that the RVX implied a move greater than what actually occurred. All right? So out of all the days going back, probably about 2,300 days going back there, okay, 1,527 had the incident where RVX implied a move greater than what actually came about. And 771 days since May 5th of 06, the market was actually more volatile than what the RVX was implying. So that's the random distribution. Let's look at a percentage there in that case. 66% of the time, the RVX implied a move greater than what the market actually moved. And 34% of the time, the market moved more than what the RVX was implying. See that? So those are important numbers. Those are important numbers because if you compare, and we're going to go to our baseline edge here. Just keep in mind, okay, so keep in mind, 66% of the time, the RVX failed to move more than a standard deviation at any time. It failed to touch the one standard deviation move out of the money in either direction, basically. That's another way to express this. 2/3 of the time, it failed to hit the 21 bar one standard deviation barrier or target, so to speak. Now, if you go to a probability calculator and you plug in, well, here's the Hoadley one. You can plug in the numbers, and it gives you theoretically a probability of price touching, and I tried to do my best to plug in the one standard deviation numbers as best I could here. Hoadley is saying that if the market moves the same as what the volatility input is, that on average, one of those standard deviations should get touched 63% of the time. Okay? 63% of the time. And so, we see a problem there because what happened in the Russell was far less. Here's TradeKing's probability calculator. And here it'll determine the probability of touching, either the upper boundary or the lower boundary. Here it's working out to about 54% of the time it should touch either the upper or the lower one standard deviation move. So Hoadley is up there at like 63. This one is like at 54 when you round, something like that. When you go to OptionVue's Monte Carlo-based probability calculator and you plug in the one standard deviation as your targets, the probability of ever touching goes much lower using this type of a Monte Carlo-based calculator. In this case, with this time range, it was 27 and 26. I'll be honest, after playing around with OptionVue's probability calculator at different inputs, different time frames, etc., sometimes it goes below 25, sometimes it's higher. It's an iteration-based calculator. I'm just going to round it to 25%. That seems to be the consensus when talking with other much more quant-gifted folks than me. They kind of settle in on that 25% number. Basically, either one standard deviation move should be, on average, touched one time in 4. That's a pretty good number. Okay? So, if the market moves the same amount as on average as is being predicted, it should touch either side 50% of the time. That's what you see down here. What does the Russell actually have going on, though? What actually happens in the Russell? Well, it's actually touching only 34% of the time instead of 50. Okay, it's staying inside the standard deviations 66% of the time instead of 50. There's a baseline selling edge, it would appear, just simply being in the Russell, you have a baseline selling edge of 16% based upon this analysis here. It would be much greater if you believed the Hoadley calculator or the other one, the Trade King one, okay? So there you have it, the baseline edge. Now, if we're going to throw in technical studies, seasonal studies, we need those studies to produce results better than that 16% selling edge, or better than that 66% number there. Okay, we need to hone in on an approach where the market is going to stay within those deviation bars or those targets more than 2/3 of the time. Otherwise it's just a flip of the coin. You may as well just based upon the 66%. So that's what we're going to do now. We're going to now look at applying a couple different technical indicators. In this case, we'll look at the MACD, we'll look at the day of the week, and then we'll combine them and see if there's a way that we can extract a greater edge than that 66%. So here we go. All right, let me get another sip just a second. All right. So I start with a screen where I'm just showing you the chart. I'm showing you the implied move of the market versus what actually happened. And I like to paint the bars, just starting out visualizing this. I'm going to paint them blue if those bars, at the close of those bars, the market didn't move as much as what the RVX was saying. I'm going to paint the bars red if over the next 21 days, or the 21 bars, it moved more than what the RVX was saying. All right? Now, I'm going to try and come up with a way of filtering out the red and keeping as much of the blue as possible, right? Because if I could avoid trading butters and condors when those bars are red, and I only do them when the bars are blue, turn out to be blue, that would be a good thing, wouldn't it? Remember, though, on the right here, they're black because we don't yet know how much the market's going to move relative to what the RVX is saying. So I need to find a way to look at the past and find an indicator of some kind to get rid of the red and keep the blue. And what we did last time is we slashed a moving average through some of this that kept a lot of this blue but got rid of a lot of this red here. And it worked out to give us a little edge. So what else am I going to use? Well, the first thing I'm going to look at is day of the week. Okay? And what I can do is I can peg each day of the week and say, aha, that bar was a Monday. And then that's a Tuesday and a Wednesday, Thursday, and Friday. And so what I'm going to do now is say, all right, over the next 21 days, would it behoove me to sell premium on a Monday, Tuesday, Wednesday, Thursday, or Friday? Does selling on a Monday generate any kind of an edge as opposed to another day of the week? And you would think that it wouldn't be that big a deal. Well, let me show you the results here. So I went back to May 5th, and we could see here that when the market was less volatile, okay, randomly, remember, 1527 and 1,527 times, the market was less volatile than what was being implied. Okay, and that would have been good to sell premium during those 1,527 days. 771, it was more volatile, and there's the 66% at that 1,527, okay? Now, Monday, and so here, let's see, Monday works out to about a 65.44, so that's a negative 1% edge. Negative edge. Look at this, though. On Tuesday, 323 Tuesdays were less volatile. 146 were more volatile. Look at that. There's a slight edge of about almost 2.5% if you were to trade your butters and condors on Tuesdays as opposed to the other days of the week where it was pretty much flat or you even had a negative edge going on there. So all things considered, if you have a choice, it would appear that Tuesday gives you a little bit more of an edge. Remember, you already have a 16% edge, roughly, or in this case, almost 16.5. Now we're going to add on another 2.5% edge just being simply on a Tuesday. Well, okay. I think that's an interesting bit of information. You probably may have wondered that. The numbers change significantly when I run shorter-term VIX numbers, say the VXST with the S&Ps. I've done that study, and you start because we have clients that students that want to do weekly butters, weekly condors. Now the seasonalities get more intense. Okay, but anyway, on the 3-week or the 21-bar monthly deal, Tuesday gives you a little bit of an edge. All right, let's go to MACD now. Here's a MACD, and the notion here is that if you look at this chunk of red, that occurred when the MACD was, a lot of that red is filtered out if you just simply avoid selling premium when the MACD is turned down and underneath its 9-day average there. Here we would have encompassed this. So the idea here is that we're going to get rid of a lot of the red by simply not putting on butters and condors if the MACD is in a sell, and we're only going to do it when it's in a buy mode. All right, now there's other, here, let me get this. So you can see a couple red would have been eliminated from this. A lot of this would have been eliminated. This would have been eliminated here. Some of this would have been kept. You can't get rid of all of them, of course, but let's go and take a look. So what I did here is I wiped out all the bars where the MACD is in a sell signal, and we kept only the ones where the MACD is above its moving average in a buy. All right? In a buy status. So now let's run those numbers, and if we go back to May of 06, here's the random distribution at 66%. Indeed, when the MACD is up, 70% of the time, the market does not move as much as what the RVX was implying. So you work out to have an extra 3.65% edge there. Not too bad. Not quite the 5% that the moving average gave us, the 40 gave us. But now here's the kicker. And there's a synergy that kicks in when you combine the Tuesday seasonality with the MACD. And yeah, you're reducing the number of trades quite a bit, but look at this. I'm going to combine. So if we only do butters and condors on Tuesdays when the MACD is up, what kind of an edge can we get then? And here's the kicker. Look at this. The number's reduced quite a bit. But look at this, 74%, okay? Oh, and I messed up the colors here. I didn't transpose that over. 74% of the time, Tuesdays with the MACD up, the RVX is implying a much greater move than what the market actually transpires in. Okay, so we just went from having an edge of about 16%, 16.5%, to now having an edge of about 24%. Pretty good. Almost 3/4 of the time, Tuesdays with the MACD up, you're going to succeed if you sell premium a standard deviation out. Statistically, historically, the disclaimers notwithstanding, that's what the numbers are saying here, an edge of 7.5%. And so that's the real takeaway here. If you're one to look at that stuff, all right, it's pretty much documented well that Tuesdays when the MACD is up, you can look out a month, and going back, looking at the RVX, going back to '06, historically there's been an edge to selling premium on Tuesdays when the MACD is up, and a pretty significant additional edge from this. And so the conclusions, historically in the Russell, there seems to be a 16% baseline edge. A further 7.5 edge to selling premium exists on Tuesdays when the MACD is on a buy status. And that's the takeaway here. For those of you that look at that stuff, I think you'd want to gravitate towards Tuesday when the MACD is up, and then avoid other days of the week when the MACD is down. You're going to have a negative edge that digs into the natural edge that comes with trading in the Russell. So that is the conclusion. I can take your comments, questions. I think it's pretty straightforward. It's just kind of a little tidbits of info for those that like trading options in this fashion.
So Steve, I had a quick question. This edge is based on selling how far out? How many days expiration would you say?
Well, it's going out 30 calendar days, or 21 trading bars is what we used for the calculations.
Okay. And have you...
so it would be... Yeah, so at any given time, it would be a 30-day, one standard deviation condor in theory. I think, though, that the edge could be extrapolated to an at-the-money butterfly of a similar time frame. You just know that the market is going to technically or typically channel, within a range, lower than what the RVX is implying. That's kind of the point.
Manuel asked, can we get the slides? If you send them to me, I'll post them with the recording, if that's okay.
Is that what you do on your other presentations?
Yeah, if the presenters want to release the slides, and they just email me a copy, and I just post it in the archive, essentially.
Yeah. Tom, can you and I talk about that later? I want to... Yeah, let's talk about that later. That'd be great.
Okay, and Ian asked, Steve, if you also tested any edge with the elder impulse rules in premium selling.
Yes, I did. When I was doing last year, I did the elder rules. Oh, wait a minute. I was doing the elder, what's the name of his system? Where he has the MACD and the moving average moving. It was his directional approach. I haven't seen the elder rules for premium selling. I was looking at his he likes to look at the MACD slope versus the moving average slope. And I did test that using the statistical edge analysis, but I'm not familiar with his premium selling rules. I'll have to look that up. Do you know what book that's in by chance? Is that coming to my trading room, or is that in another article perhaps? I don't know.
Oh, while Ian is answering that, we had another question. Have you done any similar studies with SPX and the VIX?
Oh, yeah. Yeah, and that's kind of, when I do my installments on my Inside Wire series, I've explored SPX, the VIX, and then most recently I've done a whole bunch on the VXST, which is the 9-day VIX. And that's really of great interest for folks that want to do on weekly butterflies and weekly condors, that kind of thing. And there's similar results, but the days are different and the edges are different and all that. It does vary market to market. Interesting. It does vary. They're similar but not the same for sure.
And Ian said, yes, it is directional. I only mentioned premium selling because of your test here.
Oh, yeah. No, I was looking at his approach. I mean, he has a lot of different systems, but I was looking at one of his where he takes the MACD and I think it's his 13-period exponential average of the slope of that compared to the MACD slope, and if they're congruent in a slope, then you have momentum and direction going at this end. And I did look at that, and there's a slight edge, but I look at it all from all markets in that case. But that statistical edge stuff is a whole different line of inquiry than volatility stuff we're doing here.
Oh, I see Jim Graham's here. Hi, Jim. And he says the triple screen.
Yeah, I didn't test the triple. I forget, what was my Alexander Elder thing? Yeah, no, I have not tested the triple screen approach. No, I'm familiar. He uses a stochastic for the pullback and all that. And but that would be under the statistical edge stuff I did. That was last year's project, and this year I'm up to my ears in this volatility edge stuff. But that's a good one to go after. I could certainly take a look at that, the Elder triple screen approach. That's kind of published out there publicly. There's articles on it, and it's been around for a long time.
Steve, this is Jim. You had mentioned that if you take a look at a shorter period of time, meaning not going back to 2005, that your numbers were different. One of the things that's happened is that the whole put skew kind of really changed over the last, 4 years or so. When you went to a shorter time frame, how did it end up affecting your results?
Well, it really is affected when you go back using the SPX, because you can go back so much farther. And what I tried to do, well, with the Russell, I only went to 06 because that's as long as the RVX has been published. And so if I were to reduce that time frame, I might remove a period of bullish or bearish markets, and it would then skew it a little bit. Let me go up and just show you this just real quick. All right, so on this screen here, when the market's going down, quite often you can see that the bars are painted red, and that the market in this case back in 2014 September October, and this was kind of you see this kind of pattern develop quite often. When the market is going down rapidly, the RVX is going to imply a move less than what the market is going to actually do. And so even though RVX might be going up, or the VIX could be going up, what happens in the future is often more than even what that VIX is saying, or the RVX in this case. Why? Well, because you get these V bounces that can really send the statistics out the door that way. And so if I were to take a shorter period of time, or if I were to take a slice of time and not include the bear markets, I would skew the results very much in favor of the edge there. But what I try to do, and in all my VIX studies, I go back to the beginning of 2000, so I try and incorporate a balanced division of bullish and bearish markets. That's what I'm saying. Mm-hmm. We try.
Okay. The other thing that I'd end up asking is that you're using the RVX, which is a single implied volatility number, and you're suggesting to sell the put and the call one standard deviation out, right?
Right. Well, we're just saying that the market doesn't move and hit those targets a certain percentage of the time. Okay. Of course, we all know that those calls, right, are very cheap sometimes, and you got to kind of look at it sideways and go, is it worth it, right? And so, but that's another question.
So you didn't look at how cheap the calls were, or you didn't take a look at what the skew was, meaning how much more expensive the puts were versus the calls, because one of the things that we measured was skew, and for a good chunk of this year, surprisingly, during the first 6 months, what we found is that when we take a look at on an annual basis how expensive the calls are versus the puts are, equal distance out of the money, we found that the puts have been running usually 2 standard deviations, meaning that they're about in their 95th percentile of how expensive they end up getting compared to the calls over a 2-year average. When we're looking at this, it's a statistical work, but we'd also then have to end up finding out, well, what's the real implied volatility we're selling, right? Because let's say if the RVX is at 20 and the call is at, 15, but the put's at 25. So we'd have to end up taking a look at what we'd actually be getting for those. I mean, this is definitely, great work, and it's a first step, but if you're going to actually end up trading off of this, you'd have to then go and take a look at what the difference in the money that you'd be getting for it.
Well, and you could just simply sell the put spreads. And avoid the calls altogether, or do something like, just a hedged bull put spread. That's what I like to do. It's a hedged bull put spread, something like that, so that your upside is, you don't have the risk up there. And, maybe, I don't know, Jim, maybe the last time we talked about this, because I did go down a rabbit hole of a tangent with the skew, S-K-E-W, that symbol. I don't know if you've looked at that.
I had.
And I tried to, let me see. Okay, so when you look at the implied move of the RVX and compare it to the red line, well, what if you were to take the skew function and tweak around with this blue line, the implied move of the RVX, or in this case, it would be the VIX. And I started down that rabbit hole, and I didn't find I was getting much different results, to be quite honest.
Right.
But that is an area I went down. I got down the path, and then the path went off in 10 other directions, and I kind of backed up and went, okay,
Yeah. No, it's a tougher question, because the thing is that we always try to do is we try to take a look at our specifics and what we're doing against them.
Yeah.
Against the specific strikes that we're selling.
Yeah, and at the end of the day, you'd have to just run a back test. You're right. I mean, you'd have to dive in and take a look. The only automated way to do that is to use that skew function somehow embedded into the algorithm that gives us this blue line down there when we compare it to the red. And so presumably it would move this a blue line, just if you're going to factor in those more expensive puts, it would move the blue line a little bit higher.
Exactly. Right? My thought was that's what was going through my mind when you said do this when the MACD got positive. My thought was, let's sell the puts when the MACD is positive, because now you're going with the trend.
Yes. Oh, absolutely. That would be another way to look at it. Sure. Now, I don't know if you know that. Have you guys talked about Karen the Super Trader much? We know of her, and statistically, right, it makes a lot of sense, because what she's doing is she's selling naked puts below the money, so the IV that she's selling is significantly higher than where the VIX or the RVX would be. Well, but she's also selling nearby calls in a much closer expiration than the puts.
Yes.
And then she acquires more premium in the calls that way by going shorter term. That's her theory, anyway. The jury's out for me still. I mean, she's so far out in those puts, and she has ways of rolling it and all that. I mean, it's very interesting what she does there. But if you can pick up money on the calls, and that's what she would say, I think, why not pick up the money in the calls, even though you're picking up pennies at a time instead of dollars like in the puts, kind of a thing. But
if you get hit on the call, she figures she's making a good chunk of money on the on the puts, right? Because the longer term puts, the IV is going to get crushed. So not only is she going to make delta dollars, if you think of it that way on the puts, and make her theta, obviously, as time goes by, but also if the IV gets crushed because it moves higher and she ends up getting threatened on those calls, she's going to make more money on the puts. So I understand the counterbalance and the argument of it. I haven't done the back test of it, but in theory it makes sense.
Yeah. I mean, the issue is, do you want to play in the calls or not? And
yes, true.
To hear her talk, there were times when she certainly wishes she wasn't.
Right.
The
thing is that if you go and you take a look at selling naked like that, and this is just me, but and you go and do, let's say, 100,000 Monte Carlo simulations on doing this on a monthly basis. Mm-hmm. What you find out in 100,000 simulations is that there are going to be a few months when over the 100,000 instances when you get really, really hurt. Okay, the challenge is how long will your luck last? Because 100,000 simulations, by the way, is about 8,300 years. I don't know about you, but my life expectancy is a lot shorter than that.
Sure.
Okay. So if I get hit, with my luck early on, it could take a very long time to recover.
Well, I mean, we're not discussing, though, the management rules we would use for any of these approaches. Whether you're doing butterflies or, we like broken wings, and we like, our algorithms for managing it are different. I mean, everyone has their secret sauce. And, we've back-tested ours, and everyone's back-tested theirs. But there is a way of managing, and hopefully folks aren't just putting on a condor and closing their eyes, right? I mean, we certainly don't. You shouldn't, in our opinion, play with the fire. And that's one of the most deceitful things about high probability trades is that, when it moves against you and you're losing several times what you could make, your probability, it could still be at 75%, but it's hugely deceptive. And you tell yourself, well, the market just can't keep going down. It has to come back. The probabilities say so. Well, we all know that we all know how that's going to end. So, and I think, if you've been around doing this enough years, we all have our own little stories we can tell where we got suckered into that kind of mindset, and you learn through experience. At least, and we have our people do back testing and learn that way before they put on real money. You got to learn to stay away from the fire. Don't get too close to the oven. So.
Hey, Steve, a quick question from Mike Schwartz. He says, so does MACD need to be moving up, or I think he said you said in the last screen a buy signal. He's confused on which one that is.
A buy status, meaning that the red line on the MACD, the 1226 oscillator, is above its 9-day average, which in this case is the blue dotted line. That's a buy status when the MACD, when the oscillator, the 1226 exponential oscillator is moving up, and it's above the its own 9-day average. That would be a buy status.
Got it.
And it's just a standard MACD setting. 1226.9 is the standard MACD setting. I mean, it'd be interesting to tool around with that and try and mess with it, but I'd probably improve it a little bit, but these are just the standard settings.
I don't see any more questions. The last chance for questions for Steve before he goes. And Jim, do you have anything else for Steve?
No, just Steve, thank you very, very much for coming back. We really appreciate it. It's always very insightful. It definitely makes us all think about things and going back and taking a look at our own trading. We appreciate you coming on.
Sure. Well, thank you for having me. I appreciate it. It's been a lot of fun.
Yeah, thanks, Steve. We look forward to having you back in the future.
Excellent. Thank you.
right, thanks everyone. We will see you later.
Hey, thanks a lot.